welcome to The Trade on this Thursday. Well, let's first, though, take a look at what the traders are watching out there. The European Central Bank likely to lower interest rates again tonight, arguing inflation in the Eurozone is now increasingly under control and the economy is stagnating. Taiwan Semiconductor Manufacturing, the dominant producer of advanced chips used in AI applications, is expected to report a 42% leap in third quarter profit thanks to soaring demand. And stateside Morgan Stanley's profits surpassed estimates on a bumper third quarter for investment banking that's buoyed rivals, sending its stock to a record high. Meanwhile, Boeing closing in on a plan to raise $15 billion with common shares and a mandatory convertible bond as the aircraft manufacturer bolsters finances worsened by a crippling strike, but that timing remains unclear. Let's now turn to the charts that traders are closely eyeing at the moment. Earlier, I caught up with Carly Garner from DeCarlyTrading.com and asked her about the position in treasuries, which she says is looking particularly precarious at the moment.
To be honest, it's a little alarming. What we're seeing in the U.S. futures market is we're seeing speculators and even large institutions placing a very, very large bet against the Fed. They always tell you don't fight the Fed. Well, there's a lot of big traders and probably those considered the smart money that are betting against the Fed. I'm not sure it's going to pan out. But let me just tell you what's going on under the surface. So we've got on the future side of things, speculators are holding about 1 million net short contracts. That's about 35% higher than what they were holding in the lows of 2018. Funds are similarly positioned. They're holding, I think, 2 million net short futures contracts, which is about double what they had in the 2018 bottom. So what this translates is to everybody is short treasuries, meaning they're betting for interest rates to go higher. My best guess is we're going to get some sort of a short squeeze or some sort of event that surprises these traders and forces them to cover. And if that's the case, we actually are going to get the opposite. We'll probably see sharper, lower interest rates and higher treasury prices.
All right, so can we learn from the past, though, given what we've seen, perhaps to determine what could come next?
Right. So this is a very similar setup to what we saw a few months ago in the yen. If you remember, the yen carry trade got really out of hand and then it had to unwind itself. So the same kind of things going on in treasuries. And the other thing to keep in mind is this position that's accumulated to such massive and I forgot to mention, but this is the largest net short position ever in the history of Treasury futures. Not only the largest, but it dwarfs the previous record. So it's a really, really sizable bet. And I'm not sure what they're thinking. Well, I do know what they're thinking. I think the idea is they think inflation's going to come back and we're going to have another wave of inflation, kind of like what we saw in the 70s and 80s. But the reality is we're a lot better at producing commodities. And crude oil, grains, things like that. So I think inflation is probably going to be better held down this time around than it was last time. That said, anytime we see the Federal Reserve start to lower interest rates, they generally don't stop and they generally go pretty quickly. You can see in this chart, over the last 20 years, we really haven't seen interest rates higher than where they are now for any long period of time. And once they do start lowering, they generally go very, very quickly down to 1% to 2%. And I think, believe it or not, I know we don't know what the event or what the catalyst is going to be yet, but I think they will probably at some point will be enticed to do just that again.
Well, of course, we do have the election. That is a potential
True.
mover as well, isn't it?
Yep.
All right. So you mentioned, obviously, perhaps learning from history there. I also see you drawing similarities, dare we say, with the financial crisis. What do you see?
Correct. So if you look at a 20-year chart of the 10-year note futures, we've drawn a pivot line. It's a blue line right in the middle of that chart that kind of separates the bull market from the bear market. And you can see we're right on the cusp of that. And I do believe that we are going to hold and start seeing treasuries head higher, yields lower here in the next couple of weeks. But of course, the jury's still out. That said, that chart, you can see that there's some similarities between what we're seeing over the last handful of months and what we saw in 2008. And I've pointed this out on the show before. There's a lot of things going on in the financial markets, first the yen, then the stock market, that are kind of lining up to that 2008 scenario. I'm not saying we get a financial crisis, but I'm saying things are really, really good now, but they're probably not going to stay this good forever. So be careful. In 2008 in treasuries, We had a very similar rally, and then we had a September, October break, just like we've seen this year. And then from then on, we actually had a massive, massive short squeeze, and treasuries rallied sharply higher. Based on history and based on the positioning of traders, I think there's a chance that we get something very similar.
All right, it is sounding ominous. Now, of course, Carly, one commodity to benefit most recently has been gold, certainly as that monetary easing policy has, well, expectations of it. Now, of course, it is underway, and we did see some weakness in the US dollar, which is broadly supportive of gold. So how are you viewing the precious metal right now?
Gold is going to be really tricky going forward. Everybody wants to buy gold at $2,700 an ounce, but nobody wanted to buy it a year ago at 1,800. And I think we're kind of at the exact antithesis of where we were a year ago, where sentiment is overly bullish. On this chart I've drawn, you can see that we're coming up against trendline resistance. And we've been looking at this trend line for quite a while and noting it as our upside target. Our target was a little lower, 2,600, 2,650, but the reality is markets are messy, and this is still within our realm of expectations for some sort of climactic top. We've only seen gold this overbought 3 other times in the last 20 years, and each of those 3 times produced corrections, and 2 of those 3 times produced very large and prolonged corrections. So if you've made money on gold on the way up, just protect yourself, because there's no guarantee it continues higher. In fact, based on my judgment, sentiments, trader positioning, I think everybody's long at just the wrong time, and we could be in store for a bit of a rug pull.
What sort of time period are you thinking then, Carly?
Well, you can see on this chart that the bottom of the range is somewhere around 2150, maybe even 2000. So we're talking the potential for a pretty big sell-off. I'm not necessarily expecting that. I'm just wanting to open people's eyes to the possibility. This is how gold operates. It's a boom or bust market, and there's no easy money. It's not a buy and hold market like most people think it is. I mean, it can be if your horizon's 10 or 20 years, but if your horizon's less than that, you probably want to make sure you protect profits. How fast it does it is, I mean, we don't know till we know, but the reality is gold can move very, very quickly. So it could be in the next 2 months, or let's say 2 to 4 months.
Carly Gardner from DeCarlyTrading.com, and that is the trade for this Thursday.